started. So first things first, my name is Corey. I'm from Nutmeg State Financial Credit Union. Here on the line with me, I have Scott Albraccio from CTMA. And what we're going to go over today is some 401k details and kind of questions, comments, concerns that people may have with the COVID outbreak going on right now. So first thing, just to do a little introduction on CTMA. They are a SEG registered investor advisor specializing in 401k retirement services, wealth management, and institutional investing. What they do is require to put our clients' needs before their own, and with over 75 combined years of investment insurance experience with credit unions specifically, they're here to support our retirement and investment needs. So from there, Scott, I will hand it over to you to get started.
Thank you, Corey. We do appreciate the opportunity and welcome everyone that's on the meeting today. We were approached by a state who we've had a very long-standing relationship with to do a presentation, as Corey had mentioned, on the CARES Act that came out based on the pandemic we've had here of the COVID-19. And as we were going through our thoughts on this, we wanted to make sure we were able to address in a broad perspective a number of the questions that have come up that we've talked to our clients about already, and then address some of the questions that you may have. You know, if your question is personal in nature, please be assured that if you'd like to ask it outside of this venue, we're more than happy to correspond with you via email, over the phone, or text, however it is that you like that communication to happen. What we like to do is try to keep everything broad and general for the greater good of all the participants on the phone and or on the Zoom meeting here. So with that being said, let's look at the agenda that we drew up here because we want to have specifically bring you through the process of what's going on with the CARES Act. And we'll cover the special withdrawal and loan privileges that have been established based on this pandemic. And they are numerous, and they have loosened up a lot of the longstanding regulations and penalties that are involved with this. We'll talk to you a little bit about how to qualify for benefits and what constitutes a benefit under the CARES Act, either basically a withdrawal or a loan. And then we also want to look at the long-term impacts, because a lot of times what people don't realize is when they start making decisions today, they're not looking 10, 15, 20 years down the road and how those decisions they make today may impact them in the long run. And as Corey said, CTMA Wealth Management is a fiduciary firm. We're always out looking for your best interests, and we're the ones that you count on to look past today's needs and look into your future to make sure that you're going to have the retirement income that you need. And that's one of the things that we wanted to start off by. Let's level set what's going on in the market. And if we step back and take a look at the basic overview, before we got into the pandemic, the vast majority of the 401k plans throughout the country were underfunded. Now, as Corey indicated, we've got 75 years of experience in insurance and combined experience in insurance and investments. And I've been involved in the 401k market for quite a long time. And it's always been a struggle for us to make sure that people had enough money saved for retirement. And to back that up, the Social Security Administration had conducted a recent survey in conjunction with one of the major colleges up in the Massachusetts area. And they concluded that the majority of those 401k plans are underfunded. The biggest issue that we run into when we're doing enrollments or bringing people in is trying to balance their current expenses and their monetary needs with being able to save money for retirement. You start off, especially with some of the younger employees that are still paying off educational expenses, their student loans. It makes it that much more difficult for them to save a few dollars here or there. But, it's our job to encourage you to put money into your 401k to make sure that there is some sort of savings that are starting to build up, so that retirement time is going to come around the corner quicker than you expect. And some of the other research that we found is when we talk to the employer groups, the sponsors of these plans, better than 50 or 65% of the employers that are out there feel their employees need additional education. A lot of times what we see when we go in and work with existing plans is that basically it's put in place, they do a big enrollment, they roll it over, but then there's little service on the back end to help answer those questions about where my investment should be, say in a given period of time like we're going through right now, and how much I should be saving for retirement. And to continue on that trend of where we were, 62% of the plan sponsors decided that they needed to have their employees, they recommended their employees should increase their participation in the 401k plan. In the 401k marketplace, if your employer is matching anything, it's beneficial for you as the employee to put money into that plan. Because that's the savings, that's the match that you're going to be able to take advantage of, and you're in essence doubling your money if you're putting in 3 and the employer's matching at 3. So there's a lot of benefits to saving it, but even with all those benefits, when we got into this, the vast majority of the plans, like I said, were underfunded. So let's, for example, imagine that we do have money that's in our 401k plan right now, and we are struggling because we are out of work, we've been furloughed, something's happened to our employer, we can't go back to work. The CARES Act instituted some changes that are beneficial to the employee, if you will. Everybody should be familiar with the penalty for early withdrawal prior to age 59 and a half. That meant if you were to take any of the money out, withdraw out of your 401k, you would pay taxes on that money. And there'd also be a 10% penalty for you to do that. Well, the CARES Act has relieved us of that burden of not having to pay that early distribution penalty of 10% prior to 59 and a half. One of the other things that this does is it extends the payment of your taxes that are due. So right now you've got qualified pre-tax dollars going into your 401k. At some point in time, you have to pay Uncle Sam and Uncle Lamont for those funds. And usually it's done at the time of the withdrawal. Now, under the CARES Act, they've been kind enough to extend that out for a 3-year payback period, meaning that you don't owe that on day one. You can extend and chunk that tax burden out over a period of time rather than upon withdrawal of those funds. So what they're doing is that they're building it. They're giving you access to the money penalty free. They're allowing you to pay the tax liability on this over an extended period of time, which are 2 beneficial things to you if you're in a hardship situation where you need to take some money out of your 401k. And this is really, these are particular to the withdrawal feature on the plans. I would encourage you, there's 26 participants on this call right now. I would highly recommend that you check with your plan sponsor to make sure they've enacted these hardship provisions into their plan before you assume they go in there and do that, because it was an opt-in type of situation for employers to allow this to happen. One of the other benefits of the CARES Act was there was a maximum withdrawal of up to $50,000 in your 401k. And now they've extended that out to $100,000. So meaning if you had $100,000 pre-CARES Act, the max amount to withdraw would be $50,000, but now they've moved that up to $100,000 if it's available. And not to be taken out of context or lost in the long run is your ability to pay yourself back, which is in a financial advisor, we would highly recommend that you put the money back. Use this as a temporary bridge if it's your last resort. But we would look to have our clients pay themselves back over a period of time. Put the funds back in so they go back to work and they're there for your retirement, because later on in the presentation, we'll be talking about how that can really impact your future plans. The other thing, the other caveat to this is that if you are going to make a withdrawal, from your plan and you want to take advantage of these benefits, it needs to be taken out by December 20th of this year. After that, it will not, unless they extend this out past that, this option will not be able to be there. This grace period, if you will be rescinded at that point in time. So as we sit here and look at the options for taking withdrawal out of your plan, and we want to sort of pause before we go to the next slide, because we'll talk about how you need to qualify for this under it, because there needs to be some sort of impact to you to make it available option to you. So Corey, do we have anything coming up on the chat right now as it relates to any of the information that we've covered so far?
Besides me just typing no in it by mistake, we do have a question from Linda. The question was, what qualifies you to make a withdrawal? And do you have to prove hardship? And if so, how is it determined?
Well, she helped transition us right into the next slide. Thank you, Linda. We do appreciate it. So the request must meet the COVID-related criteria that has been set forth by the government, meaning that a person needs to be diagnosed with COVID-19 by a test approved by the CDC or FDA. A spouse or other dependent needed to be diagnosed with that. Or if you were quarantined, furloughed, laid off, or a reduction in hours, you're unable to work because of childcare issues where you need to take care of your child, or you own a business that was forced to close or reduce hours of work. The reasons or the ways you would qualify for this hardship withdrawal under the CARES Act. So Linda, that I appreciate you transitioning us into this slide, and that was put forth by the government, and that's the criteria that one must meet in order to qualify for withdrawal under the CARES Act.
Now, thanks, Scott.
Sorry. No problem. Yep, there's not a problem.
So just a reminder for everyone, I know I said it in the beginning, but if you have any questions, please do it in the chat. We have some, Linda, like I said, put a question in the chat, and then I have a question or a comment here from Christina. It says that she feels like there's some gray areas. Do you want to comment on that? Being diagnosed or have been diagnosed, says Christina.
Gray areas is being diagnosed with COVID-19, or I'm trying to find the gray area. It's either you're diagnosed with COVID-19 or a spouse or other dependent was diagnosed with it that you're in the household with. So you would have to get a COVID test that's approved by the CDC, have positive results, and you would meet that gate check criteria, if you will. Or if your spouse or other dependent tested positive, that would also meet that. So if you can clarify her question in terms of what gray area she's looking at, I'd try to delve into a little bit deeper for her.
There was one other item there. It says, if you were quarantined for what length of time? I know that was...
It's going by the standard definition that Dr. Bricks and the CDC and the FDA put down. If you were quarantined, then the minimum quarantine period was 14 days.
Great. And then I have a question from Brian. Are you going to have to prove it by any documentation?
Yes, you will. That would be a positive test result on COVID-19.
All right, looks like that's all the questions in the chat for right now. So if we want to continue on.
Okay. So we've covered the withdrawal privileges under the CARE Act, which is different than taking a loan, or if you had a loan currently on your 401k. That had a separate set of criteria that went around it, and some relief for those of us who may have been in the position where we were paying ourselves back for taking a loan out. So if we move to the next slide, we can see here that all loan payments were suspended going into their payback period for the remainder of 2020. Meaning if you had a loan out and you were paying it off by biweekly or per pay period, if you will, that ceases to happen and will not restart until after January 1st, 2021. One of the things that you need to remember, though, is the loan will continue to accrue interest while it is not being paid. And what will end up happening is they're going to re-amortize the loan. So they're extending it out. They're compounding they're amortizing the interest that would have been due. And you will make a new loan payment starting in 2021. So that you need to be aware of that. So it's not going to be like where I'm saving or paying off, $50 a pay period now. It will increase when you go on loan suspension to a higher amount starting in the next year. So this is to take into consideration for those people, remember, who've taken a loan out from their plan rather than taking a hardship withdrawal, if you will. For new loans, anybody that goes in and applies for a new loan, your payment will start in January 2021, which is different because usually they start the next pay cycle after the paperwork has been complete for repayment on that. So there is the ability to borrow money in 2020 and not have to start repaying it until 2021. But just like anything else, they're always going to, amortize the interest and accrue it. So it's not going to save anything in terms of that. It's just going to help temporary relief during this crisis period. So two different options that you have as an employee. You have the option of taking a hardship withdrawal and everything that comes into play with it that we just covered. And then the loan payments, they've given us some relief by suspending the payments until 2021. And if you go in today and take a new loan payment out, or new loan out, your payments will not start until 2021. So questions on lending or loans coming out of your 401k as well.
So Scott, I got a couple questions from Irene, not necessarily rating on loans, but regarding stimulus checks. Irene's question is, she didn't get one even through her income was less than the high end level, but she took a 401k withdrawal that put her over the limit. And the question is, are the funds considered as quote unquote earned income? And then would she qualify? She took the withdrawal because she needed money, but now not getting a stimulus check.
The stimulus check was based on 2018 and 19 tax returns. I'm not sure I want to delve into that quite as deeply in a setting like this. It would take a little bit of research to understand the timing of when the loan was taken out and why she didn't get the stimulus check. I couldn't say for sure, Corey, Irene, we're sitting where I am right now, not knowing all of the details around that. I apologize.
So Irene, I know you have some other questions down here from me. If there's not something that we can get to specifically for you, we'll have Scott's email and contact after this webinar, and we can you can email him that as well. From Christina. So the question was, I was presumed to have COVID, but no testing was available. I was sick for 2 weeks, but have no documentation outside of a doctor indicating presumption.
I would think that under the circumstance that widespread testing was not available, I think the government has made some provisions or exceptions for that. So if that's the case, I would look to apply for it using your doctor as the confirmation source for the illness. And it's almost like, it does not hurt to try. All somebody can do is say no. They're not looking to say no at this point in time. They are trying. They've extended an olive branch out to us, so they are trying to accommodate as many of the employees out there as possible. So it would be something that I would pursue.
Follow-up question from Irene. Is the loan payment a choice, or do we have no choice in it? I don't want the loan suspension to suspend. Is it just for the CARE Act people or to everyone?
It really depends on the employer and their election of it. As I said, this was an opt-in. It wasn't mandatory, but the vast majority of the employers out in the marketplace did adopt it because it just seemed to be the right thing to do for their employees. If you can tell your employer you want to continue to make a loan payment, and you don't have to not make it. It's just that option was available as relief for those people who were financially strapped at that point in time.
From Christopher, are the loan interest rates lower for the new loan rates?
Are the new interest rates lower? They will re-amortize based on the plan document that your company has established. And usually they are prime +1. So when they go in and recalculate in January, the prime rate is lower. You probably will end up with a lower interest rate for that amortization.
Awesome, thank you. Last question for this section from Brian. I was recently let go from my company in December due to work moving away. I have a 401k loan that I'm no longer paying since no longer working. Do they become withdrawals or are paybacks suspended until 2021?
There's a lot in that question, Corey. Let's go through it. Let's go through it a little bit at a time. So he had a 401k with an employer. The employer left. He's no longer employed. And he had a loan on the policy, on the plan itself. He borrowed from the plan. And he doesn't have a job right now, so he's not making any payments for it. Is that correct?
Sure. Yep. And then the end of the question was, do they become withdrawals or paybacks suspended until 2021?
So what's going to happen is if you're not making any payments on the plan, you would be suspended under the COVID CARES Act and wouldn't need to resume payments on that until 2021, as the screen says up on the front here. So loan payments are suspended. If you were not making payments prior to that, what ends up happening is that loan that the money that you borrowed from your 401k will be considered in default. So I don't know what the timing was when you took the loan out and when you lost your employment. But if you don't make payments on a loan, it goes into default. And then what will end up happening is the third-party administrator on the plan will be notified of that, notify your plan sponsor, and you could end up being taxed on that income as ordinary income in lieu of taking it out as a loan. It's a natural default. If people don't pay their loans, pre-COVID, if you will, if they don't pay the loans, then the loan is cashed out and you pay taxes on the gains plus the 10% penalty. Now you may, depending on the timing, like I said, fall into this grace period where that early withdrawal fee may be, if they did convert it over, may be waived. But that's a situation where I would look at the timing of everything and then get together with the third-party administrator on the plan itself.
Scott just had, Brian to Scott, he had just a follow-up thing there. He said he expects a tax and is asking if there's a 10% penalty if he's over 55.
Yes, the tax is at 59.5, gets waived at that point in time. So pre 59.5, there's 10% penalty for early withdrawal.
Last question here for the loans. I know I just said last question, but this will be the last one, then we'll move on because it has to do with loans. But from Nelsie, are we allowed to take a second loan?
Second loan, no, only one loan can be on the books at one time for 401k at this point. They have not waived that.
Awesome, thank you. All right, so that cleans up the questions here. So let's move on in the presentation.
Okay. What we want to do now is, so we've talked about borrowing, we've talked about withdrawals. What I want to do, and as we preface the beginning of the presentation with this, I want you to look at what the impacts of borrowing or withdrawing funds and not paying them back will have on your retirement. What we're looking at right now is trying to get through this difficult, unusual global event that we've had. It's our job to look past this global event to try to understand what those long-term impacts are on our clients. And what we want to do is bring these to the forefront for you as participants, so you understand the decisions you make today and how they're going to impact you down the road. So what we want to look at is the fact that these plans to begin with were underfunded. So, when we say they're underfunded, one of the things that we've ended up seeing through the course of our lives here is that our life expectancy is getting longer. It's being greater. We've got better medicines out there. We've got better health care. So in some respects, when we do retire at 65 or 70, there are people out there that are going to be outliving their money, and it's just because of their health has improved so dramatically. But research concluded that a quarter to a third of the workers out there are not going to be able to maintain their pre-retirement standard of living that they had. That's a lot of retirees. So the point being is, if we use the funds that are being saved today for our retirement, it's, we're already at a disadvantage of not saving enough for retirement because we're living longer. We have other expenses that we're trying to accommodate, but we're going to impede our ability to retire comfortably when we are 65 or 70 years old. So even a small withdrawal of $5,000 today will have a compounding effect on your retirement income, whereas somebody that was receiving a 7% rate of return on a 5% withdrawal, a $5,000 withdrawal over a 30-year period would give up $52,000 of income at age 65. That's a substantial sum of money to lose by borrowing such a little amount of money today. So getting back to our withdrawals, we highly recommend even looking at other forms of borrowing outside of your 401k. Work with your credit union. You have a line of credit available. Can you take a cash advance on a line of credit? Our philosophy is anything but the retirement. The retirement account should be the last resort for people to get funds out of, because that $5,000 you take out today, if you can maintain a hypothetical rate of return of 7% over 30 years, that's $52,000 less that we're going to have to use in our retirement. When, yes, we could really use the $5,000 now, but we're going to really need that $52,000 when we're in retirement, because we're not going to have a source of income anymore except for our 401k. So more important today than ever to really contemplate where we have money available to go out and take a loan from or borrow from, and that's that's coming from a financial advisor. Everybody's in their own situation financially. They need to weigh those out, but it's our job to get you to think about that and really weigh the pros and cons of doing something like this right now. If you're going to go in and borrow, take a loan out, that's a different story than taking a withdrawal, because the loan has to be paid back, or should be paid back, because the last thing we want to do is we don't want to pay the penalty and or the interest due on that stuff. So let's look for other sources of income to pay off or bridge us through this period of time. The 401k, I'd look loan more so than withdrawal if I was put in that position to have to do that. One of the things that we always look at is what should be occurring now. I have a 401k. What should I be looking at doing? Many of the funds that support our 401ks are off their highs that we've been contributing to for the last 10 years. We've been in this bull market since the financial crisis back in 08 and 09, and we've been on a steady increase. Now is a great time to go in there and increase your purchasing power in your 401k, because what ends going to end up happening is you end up buying the same shares you were buying before, but you're buying them at a lesser cost than you'd been paying previously, which brings your share price down on an overall basis. The other thing that we've been talking to a lot of people about is evaluating the pre-tax versus post-tax contributions, which is pre-tax being your 401k, post-tax being your Roth 401k, if it's allowable by your plan sponsor to contribute on a post-tax basis. There's some advantages to that in terms of the accessibility to funds later on in life. We find a lot of our younger participants are contributing into a Roth 401k at this point in time. They're not as concerned about the tax savings on the pre-tax deduction, so they go with the Roth, and the monies are accumulated in the account on a tax-free basis compared to a tax-deferred basis. And that's one of the big conversations we're having right now with clients, is looking at what they're contributing, reevaluating their plans, looking to put more money in to bring the cost of the shares down, dollar cost average, if you will, in there, and then also take a look at the contribution status that they have right now. The other thing is, given the current status of the marketplace, given your feelings towards the market, it's a good time to evaluate your risk profile. We are not an advocate by any means of jumping out of an investment, especially after the investment's already fallen to its 10-year low, if you will. We don't subscribe to that. We subscribe to sell high and buy low, which goes up to the previous comment I made before. We want to go in there and do that, but you also need to be able to sleep at night. Hopefully not everybody is looking at their 401ks on a daily basis. These are long-term investment strategies. We say long-term, 10, 20, 30, 40 years for some. But you need to evaluate your risk profile and determine if it's still valid. The other thing is, if you're self-directing your investments, are you diversified enough? Did you have enough diversification in your portfolio to go through and minimize some of the impacts these down market cycles have been having? And then the other question you need to ask yourself is, how often are you rebalancing your account? And we talk about rebalancing. Most plans are on a annual rebalance. Some do semi-annual, quarterly. We rebalance our portfolios on a monthly basis because we're always trying to go in and capture the gains that are in those portfolios and redistribute them to the lesser performing positions that we have in there. So this is a great time to sit down and take a look at where you are and reevaluate your risk and figure out where you want to be in terms of retirement. Even though we're going through this, and it may not be top of mind to all of you because of what you're going through personally, we're here and we appreciate Nutmeg State Financial Credit Union giving us the opportunity to talk about this, but because this is what we do. We're here to look over your shoulder to make sure that if you're setting yourself for retirement success or not, and if we got to right the course a little bit, this is a great time to be able to go in there and do that. So Corey, after that, we have any questions that have come up?
So I got no new questions in the chat. I will remind everyone where the chat is, just so we have some time here, guys, for some question and answer with Scott. So I just put a hello back in the chat, so please type out any questions you have. And while we wait for some question that comes in, a couple things, some cleanup items. Just remember, this webinar will be available online on our social media and through CTMA's sites as well. It'll be through YouTube, so you'll be able to view that later tonight. It'll be available to watch, so you can replay it, see the slides again, and then I'll also add in the description Scott's contact information as well. So if you need to get a hold of Scott for any reason, we can do that as well. I got a lot of thank yous, by the way, Scott, so thank you.
Pleasure.
So guys, we'll keep it open here for another few minutes for questions. Christina just asked me, I will be posting it to Nutmeg State Financial Credit Union's social media platforms. So that would be Facebook, LinkedIn, and Twitter. And then I will be obviously forwarding that over to Scott as well, and he'll be posting it probably to his mediums, I assume, as well.
That is correct.
Yep. So you will, like I said, it'll be available later tonight, probably within the next hour or two. So just again, look at Nutmeg State Financial Credit Union's Facebook, LinkedIn, or Twitter. And question just came in from Christina. The last slide, is that the same for Roth IRAs, or same recommendation for Roth IRAs? I think the question was.
The last slide, same recommendation for, we talk over here up on the top, pre-tax, post-tax contributions is what we would consider a Roth contribution into a 401k.
Okay, good. And then another question: how often would you say you should look at your 401k? That's a good question. That's a good question, and also it's a different answer depending on the time of year, right?
Well, the different answer depending on the day too. So, I think what we do is we counsel our clients not to look at it on a regular basis. I mean, by nature, you get a monthly statement from your plan. Is it necessary? At the end of March, was it necessary for me to open up my 401k statement? No, I knew, what had happened in the account, and there was nothing I could do about it at that point in time. I know I have, 10 to 15 years left before I retire, and I need that money. So I believe I'll be able to rebound from the lows because I believe in the investment strategy that we put together and the underlying holdings that are in the portfolio. And I think that's what everybody's going to have the confidence in, is that, we're going to be in this, and everybody's on, if you listen to any of the media, people out there in the media, it's like, they're trying to predict the market in terms of an alphabet. What's it going to be? Is it going to be a U, a V, a W, an L? What you need to do is you need to look past that. You need to look at where are we going to be? How is this market going to rebound? And historically, what we've seen is that the markets do rebound. And like I referred back to the last financial crisis, is that was in 08 and 09, and we've been on a steady increase in the market up until March of this year. And we have at CTMA have been looking for that correction to come. We did not predict it, by no means it happening in March, but you have to understand there was a culmination of things that happened during that time. And I mean, what we've all lost sight of is that even before the COVID outbreak happened, the markets were starting to feel a little shake from the oil crisis between Saudi Arabia and Russia happened. That actually occurred first, and we saw the market react to that. And then on the tail of that was the COVID-19 outbreak in Wuhan that came by, and the global pandemic words were mentioned on the radio and on TV, and that's what led to the shutdown of the economy. I mean, this is when let's face it, this was a forced shutdown, and we were lucky to go through a forced shutdown with the market and the economy being as strong as it was. So get back to the question of how often, you want to, if you're curious, well, look at it on a monthly basis, but I would think on a quarterly basis, you get a better tell from what's going on. If you looked at your account from where it was on March 23rd, which is the low of the market, to where it is today, just in that time period, most of the accounts will probably be showing some pretty good gains because we've had a number of good upticks in the market. So quarterly is fine to keep track of. Don't be looking at it every day. You drive yourself crazy and you'll go gray like me.
I'm almost there with you. I feel that. So before I get into the next question, I see Pamela joined a little late, and that's okay. Pamela, we'll have, as you see, thank you for everyone for answering Pamela's question. We'll be sharing all these on our social medias, Facebook, Twitter, and LinkedIn. So you'll see that later today, as well as contact information for Scott. So next question I have is from Donald. Do similar rules apply if I want to use my 401k withdrawal to assist my kids' college tuition with an example, obviously, of no penalty?
Right now, they're allowing withdrawals out of the 401k for any purpose at this point in time. The withdrawal comes out, the money is yours. Using it for your child's education, if that's what you want to use it for, once you take it, you can purpose it for anything you want. So yes, you could do that.
Next question I have is from Ria. Can you address the quote unquote catch-up provision for those that are older of age?
Yeah, the 401k plans have a catch-up provision for those people that are over the age of 50. It allows them to make an additional contribution into their 401k. You know, your limits on your 401k in 2020 are $19,500 into the 401k. Plus, you can make an additional contribution of $6,500 into your 401k plan as well.
Awesome, thanks. All right, just going through here the chat, a lot of discussion again where our social media is. You can find it right on our website. You can see the links that my colleagues have put in there as well, whether it's through Facebook, Twitter, or LinkedIn. What else, guys? Do we have any other questions here for Scott? We're about 3:45 right now, time-wise, so we got a couple extra minutes here for chat. And if there's that, Scott, it means you just did a really good job.
Thank you. Answered all the
Actually,
questions before they happened.
while we wait for some question comes in, Scott, I don't know if you want to give a little shout out to what you do and what CTMA does. I know you did it in the beginning, but to refresh everyone as well.
Yeah, CTMA is a wealth management firm. We are a fiduciary. We take that very seriously. So we put our clients' needs before our own, as you had mentioned in the beginning. We specialize in retirement planning for individuals and businesses. We have a large block of 401k business. We have some called simple IRA plans that are out there as well for the smaller employer groups who don't want to put in a full-fledged 401k, but still can help their employees put money towards retirement time. We do a lot of work with in the veterinary market too, with retirement planning. So we are diversified besides being in doing business with credit unions. My partner and I have been servicing credit unions. He and I combined for 30. I got 30 and he's got about like 60 years just between the two of us working in the credit union industry. So we're very familiar with members. We've done a lot of work with Nutmeg State Financial Credit Union and a number of the other credit unions within the state of Connecticut and some outside of the state as well. So wealth management firm, we do a lot of individualized portfolios for people, meaning that we don't go out there and use mutual funds. Our wealth management clients all have individualized portfolios with hand-picked securities that meet their financial goals and needs. So you're getting that custom built portfolio rather than buying into a mutual fund portfolio, if you will, for growth and income. We build it, we manage it on a regular basis, daily basis, and we usually set up what we look at is a benchmark to try to accommodate our clients in terms of what their goals are in terms of yield and returns. And that's one of the things that differentiates our firm from a lot of the other ones that are out there, is that we're really a value-based investment concept. What we're doing is we're looking for companies that are paying us to own them, that really bring a dividend and or yield to us, that we can build an income stream from for our clientele. You look at a lot of the holdings that are in our portfolios are common names that you hear about all the time on the radio and or see on TV because they're solid financially, and they are paying us to own them. So it works out very well in the long run for our clientele.
Awesome, thanks. I wanted to make sure everyone knew where to find you, your experience in that. And looks like I have one last question here from Donald to just put some more clarification on the early withdrawal penalty. If money is pulled out for school purposes, will there be a penalty on top of the early withdrawal tax?
You can make a withdrawal out of the plan right now prior to 2020 with that 10% withdrawal fee being waived if you can meet the criteria of the COVID withdrawal, the COVID criteria that's set up. So Donald, you'd have to ask yourself, if we went back to that slide, do any of these criteria, can you meet any of these criteria here? And if you can, then you would qualify for the waiver of the 10% penalty for early withdrawal. If the answer to these questions is no, I've not been quarantined or furloughed or laid off or whatever it happens to be that's on the screen, then you would be subjected to the 10% early withdrawal fee.
Awesome. Thank you, guys.
And
All
we'll
right.
give Donald a minute to see if
Take
that
in
answered
there.
his question. See if that answered his question.
Scott, is it okay? I have your cell phone and email from our conversation. I'm going to put those in chat for people as well. We'll have them on the description of the videos as well. There is Scott's phone number, and I will send in his email as well. Like I said, guys, don't worry if you don't get it here now. I will have it in the description of the videos when we upload them later on tonight. Just we'll give everyone a few more minutes for some questions. Donald, there's his follow-up question. He was asking about withdrawals used for tuition.
So withdrawals used for tuition on a traditional 401k will be taxed as income, unless it's the only workaround on that is if it's a Roth 401k, then the withdrawal can be a basis and then it could be used for educational purposes. But other than that, if you make a withdrawal out of that, you would be penalized 10% prior to 59.5.
And that's what he just asked. Perfect. Thank you, Scott. Donald. Donald also says thank you. So, all right, guys, we're wrapping up here. I don't see any other questions on the chat. So I know I sound like a broken record for those that didn't hear it. This video, as well as the links to contact Scott and to get a hold of Nutmeg, will be on our videos. Will be on this video, and be sure to Nutmeg State Financial Credit Union social media channels, as well as CTMA's social media channels as well. So be on the lookout for those later tonight. We also like to do webinars on a weekly or bi-weekly basis on different subjects with different partners. So make sure to take a look at our social media, see what our next one is. We've had, this will be probably our 6th or 7th one as well. And I thank you, Maria, for thanking Scott. You got a lot of thanks out there, Scott. So great job. Thank you guys for calling in today. We look forward to seeing you on future webinars.
We appreciate the opportunity, Corey, and thank everybody for attending. And if there's any questions that we can answer that we didn't address here, feel free to email me or call me directly.
Thanks, Scott. Thanks, guys. Bye.
Thank you. Enjoy the weekend.